weeks to give people the chance to meet some of the founders behind our portfolio companies. So this evening we'll have 3 parts to it. We're going to run through 5 to 6 p.m. The first is a bit of an introduction to both Sustainable Ventures and Sustainable Accelerator 4. Then the main event will be a discussion with our investment committee members on the theme of Build Back Better or Build Back Greener, taking a look at how the pandemic has impacted both our existing portfolio of companies and how it's going to shape the investment committee's view of what our investment strategy should look like for our 4th fund. And then we'll leave some time towards the end to take questions from you. I think you'll find that you're all currently muted, but if you have questions, if you could put them in the chat box, that would help us to manage the Q&A session. And if you could put them to the everyone function to give all of our panelists who are in various different locations a chance to see them, that would be much appreciated. So just to introduce a little bit about Sustainable Ventures, for those of you who don't know us, our vision is a world where climate change and resource scarcity are addressed through commercial solutions. And what that means for us is that we deliver that through a combination of sector specialist support services, specialist early stage investment in the sector through our Sustainable Accelerator that we're hearing about this evening, and through our ecosystem of startups centered around our 2 sustainable workspaces in London. People often ask us, what is sustainability, or what is our definition of sustainability? And obviously for us, it's around climate change and resource scarcity, but we also further define this through our focus verticals. It helps people kind of contextualize what we mean by sustainability. And those are 5 verticals: food and agri-tech, mobility, future energy, building technologies, and the circular economy. In terms of our investment thesis, and hopefully we'll hear a lot more about this from the investment committee through the panel discussion section, we have a 4-fold investment thesis, and the first part of which is de-risking businesses through our tailored Sustainable Accelerator support program. So our investment fund is a combination of investing and providing support to companies who we work with. Our network of startups, including Sustainable Workspaces community and the other Sustainable Ventures incubator programs that we deliver, give us wide-ranging access to early stage businesses in the sector, and that allows us to select from high quality deal flow and make highly diversified investments. Sustainable Accelerator is an SEIS EIS tax fund, and both the tax benefits that those schemes bring to individuals, as well as the large amount of government grant funding available specifically in this sector, create quite a leveraged service and provide extra protection for investors in terms of downside risk. And finally, because we invest really early at a pre-seed stage, often before kind of major growth inflection points have been achieved, that capturing value early gives us the opportunity to deliver superior returns compared to a more standard venture capital or private equity model. To date, we've invested through 3 funds. As I've said, this is our Sustainable Accelerator 4 fund. We've made 22 investments from those 3 funds, totaling a 2.4 million in investment. We're really proud of the fact that those investee companies have gone on to secure 23 million in follow-on funding to date. So close to 10 times the amount that we put in the first place. And this slide just gives a selection, well, the full selection actually of our 3 portfolios. In terms of our Sustainable Accelerator 4 fundraise, which we are celebrating this evening, we opened the private investment round at the start of the month and the public campaign on Seedrs at the start of this week. The campaign runs live on Seedrs through to the end of November or early December. We'll also concurrently be selecting and shortlisting companies as part of our deal flow selection, and be running some pitch days both towards the end of November and December. And then we intend to make our first investments from this fund in the first quarter of next year. We run a rolling process, so companies join the fund at the point of investment, and that's when their 12-month support program starts, so a rolling cohort. And as it says there, cedars.com/SA4 for people that want to find out more about that investment opportunity. As I said just previously, this is part of a series of events. Every year previously, we've run a full kind of meet the portfolio event at one of our sustainable workspaces, an evening event, an opportunity to come in and meet all of the portfolio companies and to meet us and to have a glass of wine or something else with us. And obviously a little bit harder in these times. So in lieu of a full meet the portfolio event, we'll be running these webinars on Thursday evenings to meet some of the portfolio companies, the first of which will be next Thursday, and there'll be a following one on Thursday the 5th of November, and we will be sending out correspondence about those events. Right, so without further ado, I am delighted that I have the chance to put some questions, possibly tricky questions, to my esteemed colleagues who are with me this evening. So we'll be joined by our full investment committee comprising Andrew Wordsworth and Chris Morris, the co-founders of Sustainable Ventures, and Peter Short, our Chief Investment Officer. So I'm going to stop sharing and hope that they are going to join me, and then I'm going to put some questions to them. So Irena really enjoyed it last time when I said, panel, are you with me? And then give me a wave. So I think we'll stick with that. Perhaps it'll become the catchphrase of these question and answer sessions. Go on. Yes. Oh, yeah, brilliant. So they're all here. Fantastic. So this has obviously been a really strange and unexpected year, and quite frankly gets stranger week by week. I think when the impact of the virus hit the UK in earnest with the lockdown, many of us had real fears for the impact this would have on our startup community and also startups in general. But we were particularly concerned, obviously, about our own portfolio and how they would fare. 6 months on or in, I wanted to ask each of you your personal view of how the Sustainable Accelerator companies have responded to the crisis. Andrew, if we could start with you, that would be great.
Yeah, thank you, Susanna, and thanks for that presentation. Yeah, I mean, I guess my sort of main takeaway was just how important the community in which our investee companies operate. As you remarked, we run a workspace, but equally have a sort of a wider ecosystem that we support through our various sort of activities across Sustainable Ventures. And sort of April and May in particular were taken up by, we've sort of mobilised to provide a series of webinars to provide access and information about the various government support schemes. You know, going up the learning curve quite quickly on many of those things, but then being able to go out to sort of, you know, up to sort of 50 or so companies, including many of the Accelerator investees, to provide information on that support and bringing some of our professional service partners, Jolson's and the like, in terms of providing that kind of professional advice to those companies. We also then saw a lot of peer-to-peer support and companies, you know, perhaps because of the sector we're in, recognise there's you know, there's growing the business, but equally you know, there's a wider purpose, and that makes people much more comfortable with sort of sharing experience and support. A lot of companies were very successful in securing government support. As you may know, Innovate UK sort of stepped up their support to companies that were unable at that time to access kind of civils loans and so on. And a number of companies, AirX, Thermalon, SunSwap, HydroServe, yeah, probably around about, I would say, nearly half of the companies in the existing portfolio managed to secure additional grants. I remarked the Thermalon said they actually got more money in their account at the beginning of this month than they did after we invested, because Innovate UK in particular have been advancing grants to sort of cash flow things. So it's kind of, talk about strange and unusual times. I mean, 6 months on, that's a really unusual situation, but particularly for a pre-revenue business. And then we had a number of companies and good clubs. I think revenue went up fivefold in a couple of months. They've secured £1 million. So really in the sort of curated online grocery business, great opportunity which they seized with both hands. And also it was great to see companies like that actually keeping the nation in food and sustainable food at that. We did have a couple of problems. Circular, which is in the travel and hospitality sector, clearly not a great sector to be in. But they adapted, set up an online retail shop and started bringing revenues in that way. So again, very quickly we were able to help people pivot as quickly as possible. So yes, I say I think it's overall I think it's been a tough time, but actually one in which I would say companies in the sustainable sector have fared remarkably well, given all other things being equal.
Yeah, I certainly remember April being the month in which we all became experts in furlough and coronavirus business interruption loan scheme, and how much time you in particular spent online helping companies who were kind of scared, really. I mean, it was such an unknown place to find themselves in, and so many of those companies we had made investments in just kind of weeks before lockdown was announced, so they were feeling pretty good about life, and then all of a sudden worlds were turned upside down. So yeah, it was the time of webinars and supporting those companies and putting our arms around them. Yeah, Chris, you along with Andrew and Peter spend a lot of time kind of mentoring and talking to our portfolio companies, and I wondered if I could also ask you your observations on how the existing portfolios fared in this strange time.
Absolutely. I'd certainly echo what you've just said, actually. The 2020 has given us a real opportunity to prove our worth and make sure across the portfolio companies have been making smart decisions quickly and making the most of the wide-ranging support that's been on offer. But I think many of our portfolio have actually been able to do quite a lot better than just survive, and some have actively benefited from the challenging time we've been going through, and others have played a pretty important role in getting us through it. Andrew mentioned Good Club, the online sustainable grocery business from our first fund, who've not only seen their sales spike, but have also managed to parlay that into sustainable growth and a significant follow-on funding rounds. Other examples include Hirecar, the peer-to-peer car sharing operator that we invested into really in the heart of the lockdown, who have arguably played an even more important role in providing private transport to NHS workers so they could safely travel to work using a shared asset, and more recently providing a sustainable, affordable alternative to public transport for others who need to get to work or elsewhere and quite rightly don't want to risk spreading the virus. And then there have been businesses like Petit Plis, for instance, who is a children's clothing designer you might think wouldn't have a particularly significant role to play here, but they've in fact started using their incredible pleated fabrics to create comfortable, flexible and beautifully designed face masks. All in all, I think I'm pretty proud of the way our portfolio have responded at a pretty difficult time. I'm also very glad that we have a portfolio. I think it's at times like this that the value of managing risk by spreading your exposure across different sectors and stages of development really becomes clear.
Yeah, thank you, Chris. Peter, it is your job to make sure our investment compass points as true north as it can, and things became I guess, it was like a magnet, was, desensitizing the compass at some point when we were trying to make those investments through March and April. And it would be great to hear from you around kind of how you felt that went, and the extra things we needed to do to make sure that what had looked like a good investment opportunity in January and February still was one in March, April and beyond.
Yeah, thanks. I mean, I think when the beginning of the COVID crisis and lockdown period hit us, I think I may have got this slightly wrong, but I'm not sure we'd even completed our first investment out of cohort 3. We'd just completed the last couple of investments out of cohort 2. And one of my main worries at that point was whether we would simply have the management capability to make investments, irrespective of what we thought about them, whether we could just make a properly run, thought through, diligenced and sort of respectable investment process work, so that we could continue to do business, or whether there'd be something so difficult about the new situation that our basic business would grind to a halt. And that worry didn't last very long, actually, because I was incredibly pleased at the resilience of our capacity to do business. And equally, I've got to say, the capacity of our partner seeders to complete on the transactions, because, they're critical to this as well. So the basic machinery kept working, and that was a huge relief. So we were able to properly diligence, properly value, structure and complete transactions in a timely way. So the day-to-day business of the Accelerator as a fund management operation wasn't compromised. And I remember the first investment committee meeting, because the way we work is we have weekly investment committees on a Monday afternoon where we go through the transactions. And the first meeting we had after lockdown, all the papers were there, all the due diligence papers were done, everything looked okay, and it sort of worked. And we found ways of doing an appropriate level of due diligence in a distanced way, and getting good results. So the machinery worked. Now clearly, the new world sort of impacted on how we considered and how we valued the transactions, and there probably were one or two that sort of didn't make the cut, that prior to the COVID situation we might well have decided to back, and businesses that were more consumer oriented, that perhaps involved more complex operations, we sort of may have stepped back from. But others, actually, the COVID situation hasn't had any real negative impact on them operationally whatsoever. And I'd think there of Minvero, again, which is a business, for those of you who don't know it, which produces specialist environmental impact assessment software for mining businesses. And one of their main clients are lithium miners. And obviously, if you want electric vehicles, you need batteries. If you want batteries, you need lithium. So it's important that the lithium is produced as cleanly as possible. Their business has sort of stepped forward really well in that. They've developed customers who've got their first client, major client with Rio Tinto a week or so ago. They've also attracted grants by the score. So that business is going very well. So that's working well. And finally, the other way is part of our proposition is that we're able to give high quality and targeted support to the companies post investment. And again, we've come up with methodologies that are delivering our support effectively. Chris mentioned some of the stuff which are specific about responding to COVID, but COVID's not going to be, I hope, around forever. And we're still focusing on building good companies with good procedures, good marketing plans, good financials, So it's been difficult, but it's not been as difficult as perhaps I feared back in middle of March.
Thank you. As part of the basic machinery, it's nice to hear that you thought it all went well. I'm not sure that all of the basic machinery got that much sleep during that period. But...
Well, I think the basic machinery did a damn good job, so thanks to them.
But yeah, you're right. We in those few weeks between when we looked at investment opportunities and then we were getting them quite well progressed, and then the lockdown came. Then there was a whole kind of recut of please all produce, COVID risk assessments, and all credit to the companies themselves for being flexible, nimble enough to do that and to consider their position at that point. Yeah, thank you to you all for those thoughts about our existing portfolio. I wanted to move now to investment strategy for Fund 4 and how that's going to look. Build back better, or now build back greener, has become the unofficial slogan for the recovery, and it neatly brings together both the need to address the economic downturn of COVID and the long-term climate crisis, which is of course where we place all of our investment focus. As we look at raising and investing our fourth fund, as we currently now are, we know the world has changed, but how do each of you see how that will shape or sharpen in particular areas the investment thesis for the new fund? Andrew, I think we'll come back to you so that we know that you're still with us.
Great, thanks for that, Susanna. Yeah, I think overall, I sort of reflect on the environment seems to be getting sort of better and better around the sort of sustainability sector, and particularly sort of awareness of climate change, and that's driving an awful lot of action in terms of the unanimity of this Build Back Better message that's coming across from investors, from government, from consumers. Notwithstanding that, clearly we're looking at tougher economic times, but our mission is going to remain unchanged. It's about delivering the world's leading sustainability businesses, and this is an ever increasing number of companies that we're coming across who share that vision and want to build those commercial solutions. We'll clearly focus much more, or continue to focus on value proposition, innovative value proposition, and really smart business models. But I think the key thing, and this is has steered Sustainable Ventures, is this principle of a sort of capital efficiency. And as a small pre-seed fund, currently without access to investment capacity to support really capex intensive businesses, we're going to continue to focus on those capital efficient opportunities, and look for companies that are going to be out there building better, cheaper and stronger sustainability solutions.
Yeah, thank you, Andrew. Chris, if I could turn to you and ask you this same question, your own thoughts on how our investment thesis for Fund 4 might be sharpened by the current crisis.
Absolutely. I think what Andrew's just said is right in terms of the broader context. Both individuals and the financial markets are increasingly recognizing the importance of sustainability as a theme, regardless of the seismic impact that the pandemic is having. I think if you were to look at press column inches at the moment, you've got the pandemic and then you've got Brexit, and there arguably isn't much oxygen for anything else. But I think that's with the exception of climate change and resource scarcity that are of such global significance that they aren't being drowned out by that noise, and if anything are climbing up people's totem pole again in terms of priorities. That said, we are looking particularly at sectors and business models which are either part of the COVID solution or perhaps more specifically, which are going to be well aligned with some of the larger societal trends that we think the pandemic will drive. And a few things which I'm looking at in particular includes a return to localism, particularly in the food supply chain. Shared mobility, which obviously isn't new, but which is set to gain, I think, significant additional traction as our transport networks change, in part because of COVID. And we're finally seeing some models begin to stack up economically that have been loss-making for a decade or more. And thirdly, virtual, flexible or remote service models, building on the wider theme of digitization, which has obviously been a meta trend across all sectors. Fundamentally, I'm excited by the opportunity we continue to have here to deliver superior returns whilst helping to build the world we all want to return to when the pandemic ultimately abates, which it will.
Brilliant, thank you. And Peter, again, as our the guider of our investment decisions, what are your thoughts here? Peter, you may still be on mute because we haven't.
I apologise. The mute fairy.
I mean, if it's not one mute thing in a single Zoom webinar, then
Sorry.
it would be a Zoom webinar.
Indeed. No, I could say that COVID has changed a lot, but it hasn't changed the basic disciplines of good investing, and it hasn't changed it hasn't changed all of the experience that we've gained over the last 3 or 4 years. And in many respects, COVID, I think, is pulling forward change that would have happened anyway. And I think as we're in the business of driving change, that actually won't be unhelpful given time. Now, there are clearly certain subsections and classes of business that COVID are making really hard. I think they're making a lot of business, B2C businesses or consumer-facing businesses hard. They're making retail hard. They are making businesses that require you to bring people together, frankly, impossible and uninvestable. But on the other hand, I think Andrew said it. We're seeing now a commitment from government and from society as a whole to renewable, clean technologies. We're beginning to see significant changes in the valuation metrics being applied to carbon-based businesses, and you only need to look at Shell's share price over the last 12 months to see how markets are valuing carbon-based businesses. And you look at the attraction to low carbon and renewable energy sources and see that that's where value is being ascribed. That helps us immeasurably. And if you look at a couple of our businesses from, one from the first cohort, Rovco, which is all about delivering offshore services, much of it to the offshore wind business, or equally in the decommissioning of oil and gas technologies, hugely beneficial. And in the current the portfolio 3, Senan, which again provides IT and intelligent solutions and services to the offshore industry. Great example of a business that is proving to be very robust in COVID-19. In that it's a software business, it's an intellectual added value business, selling to some very significant clients in the offshore wind and renewable sector. So, there are a lot of businesses out there that I think will continue to do well. And of equal importance, I think, we've said that we're a very early stage investor. We're not like some of the big American funds that can follow and follow and follow and follow and follow. So we can't bankroll our own businesses. But I've been particularly pleased to see a number of our businesses raise money over the last 6 months, and raise new money, and raise that money at a higher valuation that we went in at. And I mean, obviously Zygo is one of those, but there are others. I think Andrew mentioned Good Clubs, where we're seeing value uplift, which is what it's all about. So I don't think the model is broken by COVID. In fact, I think the changes that COVID is driving will ultimately benefit us. It's just there are some sectors, I think, that are hit very badly, and we would struggle to find investable. Thanks.
Thank you, Peter, and thank you, Andrew and Chris, for those thoughts. So we're going to move on now to the Q&A session. I can see already a few questions have come in. Please do continue to put those into the chat box. So first question from Adrian, asking us about exit routes. So what will be some of the exit routes you identify for your portfolio companies and expected holding periods? I think, Peter, that's a slam dunker for you.
Okay, I'll unmute myself. I thought I could have a quiet nap there for a while. And no, exits. We tend to predicate our exit strategy on a trade sale or a corporate event of some sort of another, where I am deeply skeptical about the sorts of companies we invest in the main, but this is not necessarily the case, making it onto a public market. This isn't the 2005, 6 and 7s when some of us who were investing in those days made, we're seeing investments that we had made 18 months, 2 years previously listing on AIM. I think that world has changed, but I think there's a lot of value in some of the businesses that we're creating that would be attractive to a corporate investor. I'd be looking there at, I mean, Sean will probably shout at me for saying this, I'd be looking at Drygrow there. I'd be looking at Rovco in portfolio one as absolute classics for a corporate strategic investor, both in terms of giving a large corporate access to a new market and to a new technology without them having to bear the development risk. And I think that's likely. In terms of holding period, well, the tax benefits that we get from investing in SEIS and EIS sort of indicate a relatively longer holding period, but it, we're got to be talking at the very minimum 3 to 5 years before we're seeing an exit. And I think we need to be quite up. Might happen quicker, and management would have to take a view. But I think I don't think we're going to be seeing much money out before the end of the tax-free periods, or the tax-exempt periods. Thanks.
Thanks, Peter. Gosh, questions have come in thick and fast now. So a couple of questions from Nishant. Nishant is always very good at asking questions on Cedars as well. So when you are identifying potential opportunities, are your horizons just around COVID-19 or beyond that? Looking beyond COVID-19, we don't want to get stuck with COVID-related businesses. Now, I suspect that's slightly my fault for just asking COVID questions. But Andrew, you were talking previously about, our core investment thesis remains the same. We want strong businesses within sustainability. So I was wondering if you could just speak to that a little bit more.
Yeah, I mean, I think I think one of the things about that sort of climate change and resource scarcity, it's it's very much a sort of you need to take a longer term view. Those who've been around in the sector for a while, when sort of Kyoto came in, it was 2050 sort of 80% reductions. That's obviously moved to sort of net zero by 2050, and that looks like maybe ambitions to move that forwards if possible. But it's when you're looking at sectors and you're trying to understand trends. It's things like the ban on the sales of internal combustion engine vehicles by sort of 2040, 2035. There's sort of politicians will be outbidding them to how quickly that will happen. But it's those sorts of things that then allow you to sort of see that these events are coming down the line. And our benefit of investing at the early stages, we get access to companies who are thinking about solving those problems, and we're not competing sort of further up the pitch for companies that haven't yet developed them. So again, we do look beyond the sort of COVID. It's not it's not going to last forever, and it's about we're looking for companies that are going to be selling things in 2030. Now that may be as part of a corporate, as Pete said, that's likely to be the best exit. But if the corporate thinks they're going to be selling a load of stuff, they will pick them up earlier on, because that's part of the need they have to change. So again, what we're doing is creating solutions that maybe can be exploited elsewhere, but that's a sort of long-term trend that we're looking at. And again, we've been always pick up sort of offshore wind. Back in 2005 at the Carbon Trust, it was like offshore wind, it'll never get there. I used to be skeptical about solar. I was like, this is just so far out of the costing. It's a hobby. It's green bling. Now 30+% of power is in renewable capacity, and in a 15-year or 10-15-year period. So these things happen, and these trends do happen quite quickly. But it's being on the front end of those. That's the kind of the trick that we play, because we're part of such a large ecosystem, including governments, including corporates, including investors, and of course the startups.
Thank you, Andrew. Gosh, we've got so many questions. So I'm going to wrap a couple of them together because they're on similar or adjoining themes. So sticking with exits, can you share some of your exits and returns? And I think we'll add into that question, which we're going to fire at Chris. When did you make the first investment, and of the 22 investments made to date, how many currently look like to fail or have failed? So Chris, if I could ask you to talk about our exits and the kind of prospects failure rate in our current 22 and the first investment. That's 3 questions, sorry.
No problem at all. If I fail to answer any of them, shout at me at the end. I think, first of all, we're about to move on to fundraising, or we've begun fundraising now for our 4th cohort. Our first cohort committed its first funds right at the very end of 2017. So that's still a little under 3 years. So we haven't had any exits from those funds to date, and nor would we have expected to. We're only just beginning to reach the kind of earliest window for those first exits. In terms of performance to date, obviously it's all therefore unrealized. But from that first fund, the pre-tax IRR is in line with our target on an unrealized basis, around 30%, and on a tax adjusted basis, significantly higher than that. With all of our businesses, have to have a very clear understanding of both their funding path and of their exit strategy. As Peter mentioned before, that's usually going to be by way of trade sale, but that isn't good enough for us sitting on a slide. We actually need to understand why a corporate would make a buy versus build decision for this technology in 3 to 5 years. And in many cases, we've actually worked through the relationships we need to have to facilitate those exits. And we work with many of the major utilities, lots of the major transport providers, many of the major landowners, so that in our various verticals, we have pathways to facilitate those exits. In terms of performance more broadly and failures thus far, of the 22 investments that we've made to date, 21 of them are still trading. So we do have one investment into Autotrip, which I would certainly unfortunately categorise as a failure, and where the business is being wound up. Of those 21, I don't want to pick favourites in this kind of forum, but there's a variation between performing incredibly well with 3-figure unrealised IRRs and 5 to 10x uplifts, through to those that are a slower burn. But all of them are on a positive growth trajectory and are solvent and progressing well. I think probably the only other thing to mention on the exit front is, whilst we haven't had exits from these portfolio companies as of yet, we have from our own internally developed ventures prior to launching the Sustainable Accelerator, which have followed very much that pathway to industry exit and a buy versus build decision for the buyer. Probably the best example being our electric car sharing business, eCar, that was acquired by Europcar on a staged basis in exactly that scenario. And that took place in under 3 years, in fact, so it was a very early exit.
Thank you, Chris. I think it did. I'm sure we'll get told if it didn't. Well done. I'm really sorry to those people for whom I'm not attributing the questions. So some of the questions are being sent on to me third hand. So apologies if you're not getting attributed the question. But we've had a question about how does the investment process assess impact and sustainability, and how is that assessment integrated with the financial evaluation? Andrew, I think you would be well placed to answer that.
Great. I'm aware time is short, so I'll try and keep it succinct. In Sustainable Ventures and Sustainable Accelerator, the two of our core values are commercial and sustainable. And I'm very keen to point out we don't get involved with businesses that aren't both commercial and sustainable. Very simply, if you want to have an impact, the more things you sell, the more impact you'll have. And you know, to us, there's a straight line, there's a correlation between those two. And in order to grow your revenue, you need to attract investment. If you want to attract investment and the quantities required, you need to be commercial. So these things are self-reinforcing. But I guess in sort of technical terms, we use the UN SDGs approach, and in general, the companies we invest into will address normally upwards of three of those areas. I mean, clearly, sort of, climate change being one of the key ones, but often other areas as well. As part of the Accelerator program, we then formalise that impact assessment and set up an impact reporting process as well. But I guess in terms of resolving that it sounds like doesn't have to be a trade-off. And very simply, if you are developing a product or a service that is more resource efficient, is using less of something, or is using less energy to deliver the same outcome for the consumer, you'll have a cost advantage. And that, I guess, is really where we see a sustainable business will always outperform for exactly the same price to the consumer. And really, those are the sorts of that's sort of the approach that we would always take. And we go through that analysis. I have to say, having been, I think, been in the sector for nearly 20 years, you do get quite a good feel for where you've got sort of kind of greenwashing, where the product is great, but you're just buying renewable energy, which increases the cost base, or it needs a green premium to get off the ground. And we're not, I've never seen a successful green premium business that's out there. So but overall, I think people know about us, and if they've got a business that does that, they understand that we're the kind of investor that will back them all the way and can support them.
Yeah, brilliant, Andrew. And we publish a sustainability report for each of our funds every year, and so those are available to people that would like to see them. Peter, one for you, a technical question around our percentage participation and dilution. So what percentage do you typically take in companies? What does dilution look like to date?
I can answer the first question relatively easily, in that it's and it may not be very helpful answer, because it sort of varies. And it sort of varies between the maturity and the stage of the business and the valuation that we manage to negotiate. It can be anywhere between 7.5%, 10% up to, I think we've got some circumstances when we've got 30% of the business on day one. So not very, and I don't actually have a figure off the top of my head as to what our average, over the 22 businesses, what our average holding is. And we do get diluted, and there's no doubt about that. Though it's worth pointing out that because of the nature of the Seedrs investment process, all our investors have preemption rights and have the capacity to follow their money in order to maintain an undiluted holding in the business. And actually, I've been pleasantly surprised that a lot of our investors do use the opportunity to follow the money and to put additional cash into businesses that they know and have experience of. And quite often through the sort of events that we run, that they're able to meet the management teams. So I suppose the dilution, the answer to the dilution question is, if you like, it's the obverse of the initial position question. Our shareholdings do get diluted. Sometimes they get diluted to relatively modest proportions, but we're always looking for a net increase in the value. I mean, I think the theory here is that is that as each round of finance comes in the main, we've done very well, and each round of finance has been at a sufficiently high value to evaluation to increase the net value of our holding, whilst clearly diluting it in gross terms. Thanks.
Chris, did you also want to come in there and add something further?
Yeah, I mean, I think we work very closely with all the entrepreneurs at the ventures we invest in, and it's important that with them we build a funding path through to exit, which is realistic and achievable. And in that, to look at the various stages of uplift at different funding rounds. And as Peter alluded to, we've only seen share prices move in one direction, with the exception of the one business that is winding up. And in most cases, we've seen a 2 to 3x uplift as a minimum at each subsequent funding round. But the reality is we will get diluted, because we seek a funding path which will lead to a realistic exit, not one that will lead to unrealized returns that remain unrealized for all eternity.
Yeah.
Yeah, thank you. I'm just being pointed out that I missed the second part of Nishant's question. I would like to have the flexibility to top up my investment alongside the Sustainable Accelerator investment at the time the funds have been deployed. This is something that investors have raised on the Seedrs forum. I think I will try to answer it, because I'm the one that usually deals with that. So hi Nishant. Yes, it's not currently available as a function on the Seedrs platform at the time the initial investment is made. So far, Seedrs have progressed to a situation with the preemption rounds, so subsequent rounds, where investors can buy more than their pro rata allocation if they want to, and if there's capacity within the preemption. So for companies that you particularly want to gate the increased percentage holding in, that can be done via the preemption rounds. I will put it to Seedrs again. you know, Cedars are our platform partner. They have significant functionality on their platform, and we kind of have to be on their development pathway. But they did recently move our fund to be tradable on the second, or our fund shareholdings to be tradable on the secondary market. So it's perhaps a good time to ask them again about this point around, can individual investors join in the round at the same price? I know there are a few technical difficulties around that, but Nishan, I will follow up again and give you an update separately on the Cedars form. I'm just going to ask my colleague Irena, did we march through all of those questions? At one point, I felt like we were not going to get through them. Well, just whilst anybody else is thinking about questions they might want to ask, and we've got just a couple of minutes left, I feel like these opportunities to ask your colleagues difficult questions. Oh, I was going to ask one, but George has written, what is the future of the shared workspace in the current environment? Ooh, well done, George. Okay, Chris. So a question about about our specific workspace business and how it is faring in the
Yeah, so it's an interesting question, and one which is very much on my mind at the moment. I think we believe that the mid to long term prospects are excellent, frankly. We're already seeing an increasing number of SMEs and indeed larger corporates that, partly because of the college situation, are assessing what they really need from an office space. And increasingly what we're seeing is a desire to have a smaller HQ for executive activities and potentially client-facing activities, combined with a more flexible space that can be used for larger all-company meetings and intra-business activity when necessary, but isn't paid for the whole time and doesn't end up sitting. So those sort of flexible hybrid models and having space that can accommodate them, I think there's going to be real demand for going forward. So mid to long term, we think the prospects are good. In the immediate term, exceptionally uncertain. There's obviously no doubt about that. And the reality is people are fairly unwilling to commit to long-term costs when they don't know quite to what extent they'll be allowed to go to the office in 3, 6, 9 months' time. From our perspective, we've been trying to provide as much of the community-based aspects of our sustainable workspace virtually, whilst at the same time remaining open and providing those face-to-face services for the companies that do need to work face-to-face and do need to be in the office. But I'm confident that our sustainable workspace business, at least, is well positioned to ride through this challenging immediate time. And I think there's a real future for flexible and shared workspaces going forward, particularly where there's a thematic focus. And the startups and SMEs can really benefit from working alongside other companies that are dealing with the same investor groups, the same customer types, and many of the same challenges more generally.
Yeah, I think I'd just add to that, Chris, that I've been amazed how innovative our workspaces colleagues have been around providing space, whether that be for kind of companies on a 1 day a week basis, so more companies but coming into a dedicated meeting room or dedicated office that then we can, you know, thoroughly clean overnight and let it out to a separate company the next day. So companies can do the kind of 1 day, 2 day, 3 day a week being together whilst being apart thing, because we do have that flexibility in the space. So whilst we've seen quite a lot of change in the companies in there, but still quite good utilization of the space, albeit on fewer days a week per company. We are pretty much out of time, and I want to particularly thank my colleagues Chris, Peter, Andrew, and also Irena for speaking so candidly and sharing their thoughts both around the crisis and other aspects related to our investment thesis and our fund. As I said, yeah, we launched our public campaign on Seedrs at the beginning of this week. It will run for somewhere between 6 and 8 weeks at seedrs.com/SA4. There was a fantastic set of questions this evening. Actually, 2 weeks ago, we had significantly higher number of participants and fewer questions, so there we go. And if you have more questions that you want to ask us, you can either, for those of you who are on the Seedrs forum, you'll find me there answering questions, or email us at contact@sustainableaccelerator.co.uk. So yeah, once again, thank you to the panel, and thank you to those investors that logged on to hear us and to ask us questions, and we hope to see you again at an event in the future. So thank you very much.
Thank you.